What's going on, everyone? Travis, the Stock Geek here. It's December 17th, 2019, which means we're not only getting close to the end of the calendar year, we're also getting close to the end of this decade. So with that in mind, I want to take a quick look back before I talk about some stocks I'm looking at going into 2020. Now, one of my favorite financial websites, Koifin, had a great blog post this week looking back at some of the themes and trends of the past decade, including the performance of various asset classes like stocks, bonds, and commodities. Definitely recommend checking that out. But guess what? Stocks, as represented at least by the S&P 500 index, were the best performing assets over the past 10 years, rising about 250%. Most asset classes, including bonds, real estate, and gold, also rose just at a slower pace. And that's a result that's pretty much in line with the long-term performance of these asset classes. Of course, your mileage may vary depending on where and when you invested in these asset classes. And it's no guarantee this is what the performance of these asset classes will look like in the next decade. But regardless, my personal goal is to always outperform broad indices like the S&P 500. I'm constantly trying to find the stocks that are going to achieve extraordinary returns. And Koifin actually posted a chart in that blog post of some of the decade's top performers, including stocks like Netflix and Ulta that were up over 10x or over 1,000%, which trounces the broad market. In Netflix's case, the stock returned almost 4,000% in the past decade. And if you hold that type of stock, it can dramatically increase your wealth. But these performances are now in the past. And the real question today is, what will be the best performing stocks over the next year, the next 5 years, or even the next decade? Now, first I have to ask myself, what would a winner look like before it goes on its massive move up? So here's some criteria that I've been thinking about personally that I think might be important when hunting future big winners. And the first criteria is the stock has to have a good story behind it or a good trend. What do I mean by that? Well, Netflix's story over the past decade was that it rode this rise of online streaming and, it started making original content and original shows, and it was charging a lot less than cable charged. And so this company had a really interesting and good story behind it, and it was riding this trend of the rise of online streaming. So that was a great story. One of the better performing stocks of 2019, Roku, which is up a couple 100% this year, has a similar type of story. Cord cutting is still happening. In fact, it may even be accelerating. And Roku boxes are a great way for people to subscribe to streaming services. And there are more streaming services launching like Disney Plus, et cetera. So Roku is another example of a stock that has done very well. Now, the business has performed well, but it has this story that investors understand and can get excited about. And more investors, once they hear that story, get on board with it. So a good story is pretty key. However, story alone is not enough. The company also has to have, in my opinion, a pretty healthy financial profile. It needs to have the cash and the profits to be able to survive longer term. So there are companies that have a good story that don't meet this criteria. A good example would be a company like Helios and Matheson, which used to run the MoviePass subscription service. So this was a company that was charging people $10 a month so that they could watch as many movies in their local theater as they wanted. And they gained a couple million users back in like 2017, 2018 timeframe pretty quickly. But the company was not profitable and it kept running out of cash. So it kept having to come to the equity markets and raise more capital. So it would sell more shares, diluting the existing shareholders. And eventually they stopped being able to keep raising capital in the market. And that company went out of business, went bankrupt. So you can see the stock chart went to zero. So yeah, you need to have a good story, but the company also needs to have a good, healthy financial profile and be funded and have cash that will allow it to survive. Now, the next thing, I think it's often helpful for a company that's going to be a big winner over the next few years to have a reasonable starting valuation. If you buy a company at a nosebleed valuation multiple, it's going to be really tough mathematically to have that company go up 1,000%, in a couple years. Because it probably it's already risen a lot if you're buying it at a high valuation. So most stocks that perform really well tend to at least have a starting valuation that's relatively reasonable. And in fact, a lot of them start out at relatively smaller market caps. So you can think of like a company like Apple, which is at $1 trillion market cap. It's pretty unlikely for that company of that size to be able to go up 10x in the next couple of years, right? So you need to have a relatively small and relatively reasonably valued company for it to go on to be like one of the decade's best performers. And actually a good example of something like that would be Tilray. Tilray had a great story behind it. This is a company that's in the cannabis industry, which we all know is growing massively as states regulate it and allow cannabis to be sold. And so Tilray went public and the stock, went to the moon. But if you were an investor buying at $150, $200 per share, Tilray's market cap was north of 20 billion. And the company didn't even have much revenue yet. They hadn't even proven that they could really execute on their business plans. And so, if you bought up there, you'd be down over 80% now. So the starting valuation of the stock also matters. So that's why I say you have to have a good, reasonable starting valuation. Now, the next criteria is that a stock will often be ignored or unloved by the market before it goes on to be a big winner, because, by its nature, it can't be the hot stock of the moment already. Every investor already knows about it and owns it. It's unlikely that it's going to attract a lot more interest going forward. And, another great example of this is Netflix. Last decade, when the decade first started, a lot of people misunderstood the business model. They thought of Netflix as the DVD by mail company. They didn't think that Netflix could be successful in streaming, and they just underestimated what the company could do. And so Netflix's huge returns were in large part due to the fact that, 10 or 15 years ago, people really didn't understand the future trajectory of the business. So the next criteria would be a sharp and trustworthy management team. So Netflix, again, meets this criteria. Reed Hastings, a great CEO who laid out his long-term vision in the earnings calls and the investor letters. And, a management team can help a stock increase so dramatically above what, the equity market as a whole does, because they make a lot of really important decisions, not only with how they deal with competitive threats, but also how they deal with capital allocation, where they spend the company's money. Do they spend it on, really good growth projects that can be big businesses long-term? Do they, buy back shares when the shares are really cheap and undervalued? Or do they go and waste capital on big acquisitions trying to build an empire, at nosebleed valuation multiples? That's what you don't want, obviously. So finding a good, trustworthy management team with a company is really, really important and can make a huge difference in terms of value creation. And lastly, it's often interesting to find stocks that have catalysts, especially if you're trying to find stocks that are going to be top performers over the next, 1 to 3 years. You often want to find stocks that have potential catalysts for the stock to gain value sooner rather than later. Things that are potential catalysts might be, maybe an activist joins the board and is helping affect a turnaround, or maybe the company has, rumors of being acquired, or, maybe there's a big opportunity with a new product they're launching. Disney's a great example of that, right? With the launch of Disney Plus this year. So they're often, I kind of see this as the icing on the cake if you can get potential stock catalysts in addition to these other criteria. So, and this isn't the only set of criteria. I do think there are other bonus things that if you find can be really interesting. Things like, insider buying, or a company being in an out of favor sector, or again, like a turnaround or deleveraging story, things like that. So there are other things too that, but these are all very, very important. And if you find a number of these with a company, then I think it gives it a decent probability that it may be one of those stocks that can outperform over the next couple of years. Okay, so I've laid out my criteria. What stocks am I seeing out there right now that might meet some of these criteria? Well, I've got 4 that I'm going to talk about today. And the first is a company called Upwork. Now, Upwork is a company that runs a marketplace for freelancing. So they help companies find freelancers and they help freelancers find work. And Upwork is I would say probably the number 1 player in that right now. And the stock is a busted IPO. It meets the criteria of being very unloved by the market right now. It went public late 2018 and the stock's down over 50% from its IPO price. So yeah, you could definitely say that this one is unloved. It's also pretty small. It's only got about a $1.1 billion enterprise value. And the valuation is cheap. So it meets the cheap valuation criteria. When I look at its peers, other software or other marketplace companies, and I sort by evaluation multiples such as, the trailing enterprise value to revenue multiple, Upwork is actually one of the cheapest, if not the cheapest of this list. A lot of these software companies and marketplace companies trade for 10 or 20 times enterprise value to revenue. And Upwork today if you look at, especially if you look at enterprise value to expected revenue over the next year, trades for less than 3.5 times EV to forward revenue. Now, of course, Upwork is slightly unprofitable currently because they're investing in growth in the business. So that's why I'm looking at a valuation multiple like EV to revenue. But you can see that, it's really, really cheap compared to pretty much all its peers. And so that checks the box on one of our criteria. The other thing is in terms of story, Upwork is riding a huge trend in a market that potentially could be very large. Upwork claims that their total addressable market is north of $500 billion and that the company is just in the early stages of penetration. So remote work and freelancing is definitely growing. It's a trend that is clearly growing, and the future of work keeps being written about and talked about in the media. And Upwork lays out this slide in one of their presentations. They talk about the fact that they claim that 57 million Americans freelance this year. And of course, that number globally is even larger. They also talk about the fact that, younger generations want to be able to freelance and do other types of work. And, freelancing is already a pretty big part of the overall employment in the country. So, they think that it's a really interesting growing market, and they're still just capturing a small portion of it. So there is a story here behind Upwork riding this trend of more and more remote work and freelancing. So that checks that box. I think this stock could potentially be a longer term multi-bagger. The company needs to execute on its plans. So a lot of work ahead of it, but it's also potentially a stock I think could thrive in a recession, because if a lot of people get laid off in a future recession, they may look to do some freelancing work to fill the gap. That would actually potentially help their business. Maybe some companies want to cut full-time heads and actually just rely on more freelance work as well in a recession. So again, I don't know if that actually happens, but I could see a possibility where this company actually picks up share and picks up momentum in a recession, which is interesting because most stocks probably won't benefit from a recession. So other things with Upwork, there's a smart hedge fund I know that owns some. One thing I will note on the cautious side is that Upwork had a CEO change recently. So that is one thing that makes me a little bit cautious. We'll have to see how that CEO handles future conference calls and how they're handling their strategic decisions in the business. So the next company that I think is interesting is Baidu. Now, I tweeted about Baidu back in, I think, around early August when it was just sub $100, calling out that this company was a really, really interesting, compelling value. Now, the stock's up about 20% since then, but I still think it's a really interesting one because, it's the number one search engine in the world's most populous country. Essentially, it's the Google of China. But Google has like a north of a $900 billion market cap, and Baidu today has a $43 billion market cap. But it also has $20 billion of net cash and investments on its balance sheet, and it has an additional $9 billion of a stake in another public company called IQE. Now, IQE is basically referred to as the Netflix of China, and it trades publicly for, I believe, about a $15 or $20 billion market cap. So Baidu's stake in that is about $9 billion today at today's prices. So if you net out all of the cash and investments and the stake in liquid IQE stock, Baidu is effectively trading at an enterprise value below $20 billion. And, you compare that to Google's enterprise value of about 800 or just north of 800 billion, and Baidu seems crazy small. And the core search business can produce at least 3 billion of pre-tax income. And it also has all these other interesting growth opportunities. Baidu has one of the best AI divisions pretty much in the world, but certainly in China. They have a leading self-driving business similar to Google's Waymo, but they have that leading business in China. They have a fast-growing cloud business. They have a very dominant speech-based OS, similar to like Amazon's Alexa. But they've got all this optionality too with the cash and investments in their balance sheet. And this company, I think, is just wildly undervalued and can potentially easily be over $200 stock in the next couple of years. And the cool thing too is you get this catalyst of the trade war finally starting to move towards a resolution, and this stock is finally showing some momentum. So I think that's really nice to see going into 2020. If the trade war deals keep progressing, then Chinese stocks are, I believe, going to get back into favor because the growth rates on a lot of these companies are quite nice. So that's Baidu. Again, I have a spreadsheet here just kind of showing If you net out the cash and investments and the IQE stake, that you're not really paying a lot for the current business. In fact, even just the core search business, I think you're today effectively paying just north of 5 times the normalized earnings for that business, which is way too cheap in my opinion. So the next stock is Dropbox. Now, I doubt Dropbox will be a Netflix style 4,000% gainer in the next decade, but it's an unloved stock that I think has a lot of potential going into 2020 to have a really good market beating performance. Dropbox, as you probably know, is a provider of cloud storage and workflow applications. And the company's been consistently growing, yet it gets no love. So this stock, going back to Koyfin, you can see the growth in Dropbox revenues and cash flow over the past 3 years. It's been like clockwork. The company's still growing at about 20% on a revenue year over year is growing about 20%. It meets the SaaS, the software as a service rule of 40. And that rule of 40 basically says that, a software company that can have a growth rate plus a net profit margin of 40% or greater is, in a really, really good position, a really strong position, and deserves to, be owned. And so Dropbox is both very, very profitable in terms of its cash flow generation, but it's also growing at about 20%. So it meets that SaaS rule of 40. It's got a great founder-led management team. I've seen studies that show that a lot of owner-operator, founder-managed companies tend to outperform the average S&P 500 companies. Drew Houston, the founder, has been with the company pretty much since its founding, and he actually bought a bunch of stock recently. So Drew bought $9.5 million of stock with his own money at a price that's about 10% higher than where the stock trades today. So you can see the stock year to date did not do well, despite the fact that I think the financials and the results were good. But stock today trades even below the price where Drew bought $9.5 million of stock just about a month ago. So it's good to see him putting his own money and putting his own reputation on the line here. I always like to see that those big insider buys really are a signal to me that they believe in the long-term future of the company. The other thing that's interesting about Dropbox is it has a potential growth opportunity with HelloSign, which is a business they acquired late last year. And HelloSign is a competitor to like DocuSign or Adobe Sign. They bought that business for about $230 million. If it can become $1 billion business one day, that can add serious value to the shares. And I think that product is really good, and they got it for a good price. And DocuSign today is like a $9 billion company in the public markets. So HelloSign if it can just carve off a little bit of market share, it can be meaningful to Dropbox. The other thing about Dropbox, when I talked about criteria, it has a really strong financial profile. It gushes cash. It will produce about $400 million of free cash flow next year. And they already have about $1 billion of net cash on the balance sheet, no debt. So there's a catalyst here potentially with them being able to either buy back stock if they think it gets cheap enough, or maybe making another interesting acquisition similar to HelloSign. That cash just gives them a lot of flexibility, freedom, and optionality. And from a valuation perspective, it's a cheap stock. The enterprise value to free cash flow is about 15 times right now, and that's a below market multiple. So you're paying less than the average S&P 500 company, but you're getting a much higher growth rate here. 20% year-over-year revenue growth beats the average S&P company, which is growing at about 5 to 6% a year. And again, you're paying a lower valuation multiple to boot. So all those factors make me think that Dropbox stock from these prices can be a pretty good buy and potentially beat the market's returns over the next, call it 12 to 24 months. Now, lastly, the fourth stock that I'm looking at this week is Sunrun. So going into 2020, thinking about stocks that could ride a great story, a great trend, Sunrun is definitely one of those. Sunrun is the #1 residential solar power installer in the US, but they still have a pretty low market penetration. Solar in general still has a very low penetration relative to other energy sources. And we know that there is growing concern over fossil fuels and climate change and growing interest in solar. So that's a great long-term trend. Sunrun seems to be executing pretty well. They've been gaining share, and they're the #1 residential leader in the US in this business. So the company also has a couple of catalysts next year that they can benefit from. The first is the California solar mandate. So interestingly enough, California is requiring all new homes built starting next year to require rooftop solar panels. So that provides a nice tailwind for anyone doing solar installs in California. The other thing that provides a tailwind there in the most populous state in the US is the fact that California keeps having power outages. PG&E, the state's largest utility, went into bankruptcy because of wildfires and wildfire liabilities, and they are actually shutting off power to a lot of people now when they see the risk for future wildfires. So, solar offers an interesting solution to this problem. And Sunrun has a really interesting solution to this problem. And the solution is to have solar and battery power. So when a homeowner gets solar installed and they also get an on site battery generator, they can effectively reduce their reliance on the traditional utility grid. So if there's a power outage, they can use the power in their batteries to power their house for a certain amount of time so that they can still have power in the power outage situation. And they're also generating their electricity on site with the solar panels. So that gives people an ability to rely less on these, increasingly troubled grid operators like PG&E. So I think that should provide some incremental demand for the company as well. These are long-term tailwinds that you already get with solar, but then you get these, unique ones in California as well. Sunrun has about a $1.8 billion market cap, but a significant portion of the stock is already spoken for through contracts with current customers. So what I mean by that is, you're actually paying a big portion of what you're paying today in that $1.8 billion market cap is already captured with value that they've already generated. So you've got here, they outline it through the third quarter of 2019, basically their current contracts with their existing customers, the customers that they've installed solar systems with, will produce about $1.4 billion of net present value, or $11.50 per share. So out of the 14 and change you're paying for the stock today, about $11.50 of that is already contracted with existing customers. So you're not paying a lot for the incremental growth in the customer base here, which is interesting. One other interesting thing is a famous hedge fund investor, Tiger Global, now owns about 20% of the company. So Tiger Global is a very successful, very well-run hedge fund. It's been around for a couple decades. Chase Coleman runs it. Great track record. But you can see in the summer and fall, they were buying this thing hand over fist. And they now own about 20% of the company. And they were buying at prices above the prices that the stock trades at today. So it's great to have another really, really smart investor investing in this company. It always gives me a little comfort to have smart investors invested alongside me. So that's Sunrun. Now, it is a little bit tricky to value because there's a lot of moving parts in the financials of this company. And the balance sheet and the way they finance certain solar projects is pretty confusing. So it is a bit riskier. It doesn't have quite the same, safe financial profile that, say, a Dropbox or a Baidu would. But, I do think it's one that meets some of the other criteria of having just a really interesting trend and tailwind and catalyst behind it. When it comes to valuation, it is difficult to know exactly what investment analysts are valuing this thing on, whether that's earnings or cash flows or some long DCF model. But I will note that Wall Street analysts do expect this company to earn about 75 cents per share in earnings next year, and then about $1.20 per share in earnings the following year. So that puts the stock today at around a market average multiple in the mid to high teens in terms of a forward earnings multiple. So on that basis, the starting valuation is pretty reasonable. And if the company grows 15 to 20% a year for the next few years, that should provide a nice tailwind in terms of returns for the stock, assuming no multiple contraction or expansion. So yeah, I think if the company grows 20% a year for 5 years, then this stock could easily be a double or triple in that time frame. So that's kind of how I'm looking at Sunrun. Again, it really benefits from this great story and this great trend of people moving more into alternative energy. You've even got investment funds that are focusing on environmental sustainability, things like that. So this thing could get added to some of those ESG type of ETFs potentially. So yeah, it's an interesting one for sure. And that pretty much wraps up the fourth stock that I'm looking at this week that meets a lot of those criteria I talked about earlier in my video. There's plenty of others that I'm working through as well and looking at as we move into 2020. There's one I'm actually in pretty deep research mode with, and I'm going to be sharing that, of course, first with my Skill Incubator investing community. So if you're interested in that, I'll link that below the video. But beyond that, happy holidays and happy hunting, and I look forward to seeing everyone else in the next video. Take care.